As inflation and growth appear to be moderating over the cyclical horizon, the traditional negative relationship between stocks and bonds has reemerged, which is highly supportive of multi-asset portfolios today. Equities and bonds serve as a complement to each other, and we believe both asset classes to benefit in our baseline economic outlook for a soft landing amid continued central bank rate cuts. The return of the inverse relationship between equities and bonds enables better diversification across asset classes and allows us to position multi-asset portfolios to target attractive returns while limiting risk. Investors are also considering the potential impact of U.S. policy under the second Trump administration. We expect bond yields to remain attractive amid this leadership transition, and within equities, we favor U.S. companies that don't rely as heavily on imports, as well as those likely to be buoyed by deregulation and more favorable tax policies.
Currently, we're focused on the benefits of having both stocks and bonds in PIMCO's multi-asset portfolios. And this is important because during past rate-cutting cycles and soft landings, we've actually seen good performance from both asset classes. Now, if we look through factor and sector lenses, there are several takeaways from history. After the first rate cut, growth stocks usually do better than value stocks. Large companies tend to outperform smaller ones, and stocks with good dividend yields and quality characteristics often see positive returns within 6 months. Sectors like technology, healthcare, consumer staples generally outperform, while energy, communications, and financials lag. Regionally, we maintain a preference for the United States. U.S. stocks have a solid track record of delivering positive returns during soft landings, and we're also expecting the market to broaden beyond just the Magnificent Seven.
Turning to fixed income, bond returns have been positive during Fed rate cutting cycles across a range of macroeconomic environments. As central banks continue with policy normalization, we believe fixed income should benefit from capital appreciation. Furthermore, the starting yields of high-quality, core fixed income are strongly correlated with 5-year forward returns, meaning that today's attractive starting yields bode well for future return potential. High-quality bonds also offer downside mitigation in the event of a hard landing. In multi-asset portfolios, investors can seek higher risk-adjusted returns by stepping out of cash and onto the yield curve, adding to duration exposure. We think high-quality credit, specifically securitized credit and mortgages, can enhance yields and also serve as a diversifier. In particular, agency mortgage-backed securities appear attractively valued, with spreads over treasuries near historical highs, making agency MBS a highly liquid alternative to more richly valued corporate credit. We think it's important to hedge against upside risk to inflation amid high fiscal deficits, geopolitical risk, and potential trade policy and deglobalization trends that could push inflation higher. To this end, we see inflation-linked bonds as an attractively priced hedge.
In addition to using PIMCO's forward-looking macro views and detailed bottom-up research, we also rely on quantitative methods to identify inefficiencies and structural alpha opportunities in equity markets. We use a disciplined, systematic process based on 4 main themes: momentum, quality, growth, and value. And these themes are based on traditional metrics like earnings growth, but also on alternative data like earnings call transcripts and customer-supplier relationships. Using that data, we score each stock based on these 4 themes, and that gives us a single composite score for each stock that reflects the overall attractiveness of that company. So, rather than picking stocks, we think this systematic equity strategy based on a quantitative approach and advanced analytical tools can deliver a more consistent path of excess returns throughout different market environments.
Overall, we see compelling backdrop for multi-asset portfolios today, as central banks continue to normalize monetary policy amid an outlook for soft landing. Both equities and bonds are poised to position well.